When it comes to building wealth, two of the most common routes people consider are stock market investing and real estate. Both have been proven to generate wealth over time, but each has its own strengths, challenges, and risks. For a beginner looking to make the best decision, the question arises, which of these two avenues is more effective for building wealth faster? In this speech, we will explore the key characteristics of each investment avenue, discuss their benefits and potential drawbacks, and ultimately help you understand which one might be a better fit for your financial goals, risk tolerance, and level of involvement. Let's first talk about the stock market. The stock market is often seen as a place where investors can buy shares of companies and essentially become partial owners of those companies. Over time, as companies grow and succeed, their stock prices tend to rise, offering investors the potential for substantial returns. There are two main ways in which people profit from stocks: capital appreciation and dividends. Capital appreciation occurs when the price of the stock increases over time, and dividends are periodic payouts from a company's profits to shareholders. Historically, the stock market has delivered an average annual return of around 7–10% after adjusting for inflation. This rate of return has been shown over long periods of time, and many people rely on these returns to build their wealth. One of the key reasons the stock market is often seen as a quicker path to wealth is because it provides liquidity. When you invest in stocks, you can buy or sell shares almost instantly, making it easy to access your money. This is a stark contrast to real estate, where selling property can take weeks, months, or even longer. Because stocks can be bought and sold quickly, they offer the opportunity for faster accumulation of wealth, especially if you take a more active approach, such as day trading or swing trading. For beginners, index funds and ETFs provide an easier way to gain exposure to the market without having to pick individual stocks. Another reason why many people favor the stock market is the relatively low barrier to entry. You don't need a large amount of capital to get started. In fact, there are many brokerages today that allow you to invest with as little as, thanks to fractional shares, even small amounts of money can be put to work. Compare this with real estate, where buying property typically requires a significant upfront investment, not to mention the costs of maintenance, property taxes, and insurance. Additionally, the stock market offers diversification opportunities that can reduce risk. By buying shares of many companies or investing in an index fund that tracks a broad market index like the S&P 500, you can spread your risk across different sectors and companies, reducing the likelihood that a downturn in one area of the market will significantly impact your overall portfolio. With real estate, diversification can be much harder to achieve unless you have substantial capital to purchase multiple properties. However, stock market investing is not without its risks. The market can be volatile and prices can swing wildly in the short term. While the long-term trend for the stock market has generally been upward, there have been periods of sharp declines, like the dot-com bubble burst in the early 2000s, the 2008 financial crisis, and the COVID-19 pandemic. These events remind us that the stock market can experience major downturns, which can be frightening, especially for beginners who may not fully understand market fluctuations. Stock market investing requires emotional discipline and a long-term mindset to avoid making rash decisions when the market gets turbulent. Now let's shift focus to real estate, which has also been a favored wealth-building tool for centuries. Real estate investments typically involve purchasing properties such as single-family homes, multifamily units, or commercial properties with the goal of either generating rental income or selling the property at a higher price than you paid for it. For beginners, real estate can seem like an appealing option because it's a tangible asset. Unlike stocks, which are intangible and can feel a bit abstract, real estate is something you can physically see, touch, and control. This sense of control is one of the reasons many people feel comfortable investing in real estate. In addition, real estate has a reputation for being a stable investment, as property values tend to increase over time, especially in growing cities and regions with strong economic fundamentals. Real estate also offers multiple ways to make money, including rental income, property appreciation, and tax benefits. Rental properties can provide consistent cash flow, which can be reinvested or used to cover expenses. If the property appreciates in value over time, you can sell it for a profit. Real estate investors can also take advantage of tax deductions for things like mortgage interest, property taxes, and maintenance costs, which can increase the return on investment. One of the most powerful ways real estate builds wealth is through leverage. Unlike the stock market, where you typically need to pay the full price of a stock, real estate allows you to use other people's money OPM in the form of a mortgage. For example, with a 20% down payment, you can control an asset worth 5 times that amount. If the property increases in value, you can make a significant return on your initial investment, as the gains are magnified by the use of leverage. This is a key factor in why many wealthy individuals have built their fortunes through real estate. Real estate also offers some protection against inflation. As the cost of living rises, so does rent, which can help preserve the value of your cash flow. Additionally, property values tend to rise with inflation, meaning that your investment could continue to grow even as the dollar's purchasing power decreases. This is a feature of real estate that is often seen as an advantage over stocks, where inflation can erode the real value of your returns. However, real estate comes with a number of challenges that beginners need to consider. First, the initial capital required to get started is often significantly higher than investing in the stock market. Not only do you need a down payment, but there are also closing costs. Property inspections, insurance, and other fees associated with purchasing property. These upfront costs can be daunting for someone just starting out, especially when compared to the relatively low cost of entering the stock market. Real estate also requires a significant amount of time and effort to manage. If you purchase rental property, you'll need to find tenants, maintain the property, deal with repairs, and handle any issues that arise. Even if you hire a property manager to handle these tasks, there will still be costs involved, reducing your net returns. For someone with a full-time job or limited experience in property management, this can become overwhelming. Another challenge with real estate is the lack of liquidity. If you need to access cash quickly, selling a property can take a considerable amount of time. Depending on the market, you may need to wait months to sell a property and could face a situation where you have to sell at a loss if the market is not favorable. This is a major contrast to the stock market, where you can sell shares almost immediately. Furthermore, the real estate market can also be cyclical, experiencing periods of boom and bust. While real estate tends to appreciate over the long term, there are times when markets can decline sharply, as seen in the 2008 housing crisis. When you are invested in real estate, you are exposed to the risk of local market conditions and changes in interest rates, which can dramatically affect property values. So which investment avenue builds wealth faster? Ultimately, it depends on your goals, risk tolerance, and level of involvement. The stock market generally offers a faster route to wealth because of its liquidity, lower entry costs, and diversification opportunities. It can be an excellent choice for beginners who are looking to invest small amounts of money and don't want to deal with the headaches of property management. However, stock market investing requires a long-term mindset and the ability to withstand volatility and downturns. Real estate, on the other hand, can provide a more stable and tangible asset to build wealth. It offers opportunities for passive income and leverage, which can amplify returns. However, the initial capital required, the time commitment for management, and the illiquidity of real estate make it more challenging for beginners. If you have the capital and the desire to take on a more hands-on approach to your investments, real estate could be a powerful tool in your wealth-building arsenal. In conclusion, the stock market and real estate both have their pros and cons when it comes to building wealth. The stock market tends to be a faster route for beginners, offering accessibility, liquidity, and lower barriers to entry. Real estate, though requiring a larger upfront investment and more management, can provide long-term stability, leverage, and passive income. As a beginner, your decision should depend on your personal financial situation, your ability to take on risk, and how actively you want to be involved in managing your investments. Both paths can lead to wealth, but it's important to choose the one that aligns best with your goals and resources. When it comes to liquidity and accessibility, the stock market has a clear edge over real estate, especially for beginners. The stock market offers a level of flexibility that is hard to match with real estate investments. For instance, when you invest in stocks, you can buy or sell shares almost instantaneously, often within minutes or hours. This quick access to capital is a major advantage, particularly for those who want to retain the ability to move their money around in response to market conditions or personal financial needs. Whether you're investing in individual stocks, exchange-traded funds, ETFs, or index funds, your investments are just a few clicks away from being liquid, allowing for easy adjustments to your portfolio or the ability to cash out when necessary. In addition to liquidity, the accessibility of the stock market is another key advantage. Unlike real estate, where substantial upfront capital is often required, you can start investing in the stock market with as little as online brokerage platforms have made it even easier for beginners to get involved, often offering commission-free trading and fractional shares, which allow investors to buy portions of expensive stocks. This makes it easier for individuals to begin building wealth with minimal financial commitment, which is crucial for those who may not have the large down payments or credit scores necessary to purchase real estate. Real estate, in contrast, is much less accessible for most beginners. Purchasing property usually involves significant upfront capital, including a down payment, closing costs, and fees for inspections or appraisals. Even if you're able to secure financing, owning property requires ongoing maintenance, property taxes, insurance, and other costs that can add up over time. Additionally, if you need to sell a property, the process can take months, and there's no guarantee you'll get the price you expect, making it a less liquid investment compared to stocks. When it comes to the potential for wealth growth, both the stock market and real estate offer distinct advantages, but they work in different ways, which can influence how quickly and how much wealth you can build. The stock market has long been considered one of the most effective wealth-building vehicles, particularly because of its historical performance and ability to generate returns through both capital appreciation and dividends. Stocks tend to offer the potential for faster wealth growth, especially in the case of high-growth sectors like technology or biotech, where the value of companies can increase significantly in just a few years. Over the long term, the stock market has averaged annual returns of 7 to 10%, which can compound over time, accelerating wealth accumulation. Beginners can take advantage of this by investing in diversified instruments like index funds or exchange-traded funds, ETFs, which reduce risk while still participating in the overall market's growth. One of the key benefits of the stock market is its scalability. With relatively small amounts of money, investors can begin to see their wealth grow, particularly in the long term. The compounding effect means that even modest initial investments, if managed correctly and held over time, can result in significant wealth accumulation. Additionally, the stock market offers the opportunity for regular reinvestment of dividends, further accelerating growth. For someone just starting out, investing in a mix of stocks and ETFs can be a relatively low-risk way to gain exposure to market growth, which tends to outpace other forms of investment in the long run. In comparison, real estate offers a more stable long-term growth trajectory, but the wealth-building process is usually slower. While properties appreciate over time, they don't generally experience the rapid high-growth spikes that stocks do. However, real estate offers unique advantages through leverage and rental income. The ability to use mortgages to finance a property purchase allows investors to control assets much larger than their initial down payment, amplifying returns if the property appreciates. Furthermore, rental properties provide a steady stream of passive income, which can be reinvested, creating a more stable cash flow than stocks. Despite slower appreciation rates, real estate is often seen as a safer bet because it's a tangible asset that can withstand economic downturns better than stocks. This makes it appealing for long-term wealth growth, particularly for investors looking to create a diversified portfolio with both cash flow and asset appreciation. While the potential for wealth growth in real estate is more gradual, its reliance on leverage and consistent rental income can offer powerful benefits, especially when combined with property value increases over time. When considering risk and management involvement, the stock market and real estate each come with their own set of challenges that can influence how you approach investing and how much effort you're willing to put into managing your assets. In the stock market, risk is primarily driven by volatility. Stock prices can fluctuate dramatically within short periods, especially for individual companies or sectors that are more speculative or subject to market trends. These short-term fluctuations can be unsettling for beginners who may not have the experience or emotional fortitude to navigate the ups and downs of the market. While the long-term trend of the stock market has generally been upward, there have been several periods of significant declines, such as during the 2008 financial crisis and the COVID-19 market crash. This volatility can pose a risk to those who are overly reactive or short-term focused. However, for long-term investors, such fluctuations may provide opportunities to buy stocks at lower prices during downturns. In contrast, real estate tends to be a more stable investment in terms of price fluctuations. Property values do experience cycles, and economic downturns can lead to drops in real estate prices. However, these drops typically happen more gradually, and properties have a tendency to recover over time. That said, real estate is not without its risks. For example, properties can be affected by local market conditions, such as changes in employment rates, interest rates, or neighborhood development. The biggest risk with real estate, however, is the responsibility of property management. If you purchase rental properties, you need to manage tenants, handle repairs, and deal with unexpected maintenance issues. This can be time-consuming and require a significant amount of hands-on involvement. Even if you hire a property manager, the costs of their services reduce your profit margins. Moreover, real estate requires ongoing financial commitments, such as mortgage payments, property taxes, and insurance. The level of management involvement in real estate can be significant, particularly for beginners who may not have experience with property upkeep, tenant relations, or legal matters related to rental agreements. In contrast, stock market investing tends to be less demanding in terms of management. While it requires knowledge about market trends, you don't have to actively manage the asset on a day-to-day basis. Once you've purchased stocks or ETFs, the bulk of the work comes from monitoring your portfolio and making decisions based on broader market trends or financial goals. The risks in stock investing are more about market timing, emotional discipline, and diversification, whereas real estate investments bring a higher level of operational responsibility and capital commitment. Ultimately, stock market investing may appeal to those who prefer a more passive, hands-off approach, while real estate suits those who are willing to invest time and effort into property management and handling associated risks.